All right, well, good afternoon, everyone. I'll give it just another minute. All right, well, good afternoon, everyone. Thank you for joining today's call. Called the F word. I'm glad we were able to get everyone's attention. My name is Dennis Tender, and I'm the Vice President for DP Grow here at Dominion Payroll. With me today, I have a good, our guest and a great friend for Dominion Payroll, the President and CEO of ACG Wealth Management, Sandy Wiggins. Welcome, Sandy.
Thanks, Dennis. Good to be here.
Thank you. Our goal today is really to provide you some information on what it means to be a fiduciary, share some best practices to help you and help you familiarize or maybe put together a process if you don't already have one, and just to give you some good guides to follow. I will open it up for Q&A at the end of the presentation. So if you have any questions at the end of the presentations, please put them in the Q&A box. So with that, I will get started. So as I mentioned in this broadcast, we definitely will identify and review some best practices, some common missteps that we see and how to avoid them, ways to better protect yourself from the IRS and litigation, and some different levels of partnership, which may be best for you. Important compliance disclosure. Please note that this is not legal advice and should not replace any guidance from legal counsel. So first things first, what is a fiduciary? Well, this, as we know, is a pretty broad term and encompasses a lot. ERISA's definition is a person involved with plan administration, a person with management control over investments, or a person who gives investment advice regarding plan assets. A fiduciary is legally responsible for a 401k plan, and this would encompass both the financial side and administrative side of the plan. And if you think about that statement, that's a pretty powerful statement, and it really breaks it down into two categories. We have what's called the administrative side of things, and then we have the investment side of things. And so we're going to break both of those down today in this presentation. Well, let's take a deeper dive. So again, what is a fiduciary? ERISA spells out some basic fiduciary duties. First is acting solely in the interest of the participants and their beneficiaries, operating the plan according to the plan documents, keeping plan expenses within reason, and then diversifying plan investments. But I'd like to take that a little step further. So if you don't know if you're a fiduciary or not, you're likely a fiduciary if you do some of the following tasks. If you sign plan documents, including the adoption agreement, if you sign the Form 5500 or other government forms, if you exercise authority over the plan, and or authorities to make decisions that make impact plan assets, including how plan assets are invested. So I get this question a lot from a lot of our plan sponsors and those folks that manage the plans. What am I a fiduciary? And good general rule of thumb is that if you have some authority over the plan, if you're involved in the decision-making process, both on the administrative side or it can be on the investment side, then there's a pretty good chance that you are a fiduciary or have a liability and responsibility as a fiduciary. Sandy, let me ask you, you want to expand on that a little bit? What are some examples of fiduciaries that you see out there in the marketplace today?
Yeah, I think if you happen to be on an investment committee or retirement plan committee, you're acting in a fiduciary capacity. You may not have thought about that, or you may not even intended to be in a fiduciary capacity. But if you're on a committee and you're making decisions about the plan, then count yourself a fiduciary. The flip side of that, though, is if you are working on the plan and doing what someone else is asking you to do. In other words, if you are acting solely in an administrative capacity, then you're not a fiduciary. If you're not making decisions, but you're working on the plan based on someone else's direction, that would be a case of not being in a fiduciary capacity. But again, the real message you're making, Dennis, here is if you're making decisions, if you're influencing the direction of the plan, if you're discussing eligibility provisions or vesting and making decisions about how the plan document is drafted and designed, you're in a fiduciary capacity.
Great, thank you, Sandy. Great comments. And I want to emphasize too, because there are a number of situations where certain individuals may be playing a certain role within an organization, but ultimately they end up the ones signing these documents. And if your signature's on these documents, of course, that would definitely make you fiduciary. So let's talk a little bit about what some of the characteristics of a fiduciary are. This one I like. This is a pretty interesting term, behavioral governance. And really what this means is, and we suggest to folks, is that you have a process in place, a process that helps spell out what the accountability of each of the parties is involved with, and really some rules of process for everybody to follow. One of the things we'll talk about in a meeting is in that committee meeting is this is really helpful exercise to have in a committee, because this will help you form the framework for that behavioral governance. You know, in addition, obviously, leadership is important. Sandy, these next couple of slides, I'm going to have you talk a little bit about, because I really like the process that you and your organization use, particularly on the wealth management side. And I know you serve on a lot of fiduciary committees, but tell us a little bit too, what some of the characteristics you like to see or you see in a fiduciary.
Yeah, stewardship is pretty straightforward. And if we step back from the other big word, you know, fiduciary, and we think about what we're doing, we're really working on behalf of a group of people that are trusting us with decision-making around perhaps their most important financial asset, and that's their retirement plan. So the concept of care and good judgment and due diligence and prudence all fall under that category of stewardship. Character, we all have to have good character when we're making financial decisions. One thing that we like to always focus on, we'll touch on it a little bit later as well, is if conflicts of interest exist, let's just disclose them. You know, that's a conflict of interest doesn't mean there's a flaw in our character or decision-making process. But if we have conflicts of interest, it's important that other members of the committee understand that. The purpose of this, again, aligns with the concept of stewardship. We're making sure that in the decision-making process, we always put the interests of plan participants and their beneficiaries ahead of ours. And it's really, if you peel the onion, it's all about trust. We need to carry ourselves in a capacity that really respects the trust that's being placed with us. And when you encompass all of these into an organized process that's repeated and documented, you know, you're really doing a good job acting as a fiduciary on behalf of the plan.
Great comments. And like a lot of things in life, you know, it starts with trust. It's really having people around you that you can trust to help make sure that these processes are being followed, and really to also help hold us all accountable to making sure that we get them done on a timely and a regular basis. Sandy, I'm going to ask you to continue to expand here on some of the best practices when it comes to responsibilities, fiduciary responsibilities, particularly when it comes to selecting investments, monitoring performance, et cetera. Why don't you give us a little feedback on your process as we continue to discuss this?
One of the most important aspects of the retirement committee is to select and monitor the investments that are made available to participants. And there's a section in ERISA, it's 404C. You may not be familiar with the code section, but you're probably very familiar with how it relates to 401k plans. Participants, in most cases, get to pick and choose their investments based on their risk tolerance and time horizon and other financial factors. So our job to comply with 404C and shift the investment liability to the participant is to make sure that they have good investments. And 404C generally says you need three types of investments: cash, bonds, and stocks. Most 401k plans today have more than three individual investments. And so we as a committee need to have a documented process for what are the characteristics that we want to select and use for identifying funds that we like. So once they've been identified, we need to continue that process and monitor them to make sure that they're continuing to meet our expectations. And it's not all about performance. Certainly performance is where the rubber hits the road, but an example of a non-performance criteria might be if the fund manager changes or retires or leaves, or if the firm is acquired by another organization. Those are things that develop over time that we as a committee want to be aware of, we want to reflect on, and make proactive decisions about the performance of the fund and the underlying organization. The other aspect of bullet number 3 here is we want to monitor expenses. And Dennis will talk a little bit more about this as well. But cheap is not always the right answer, meaning index funds, as an example, are great options. By design, index funds are going to give us an average return. It is the philosophy of some plan sponsors that they want to do better than average. So we may go to an active management approach. And if so, then the expense ratios are going to be a little bit higher. But that is a reasonable increase in expenses for a service that we're looking for in the form of actively managed mutual funds. So we want to be mindful of expenses, but we don't want to let expenses drive solely the decisions that we make. We need to keep participants and beneficiaries informed. And as everybody knows who's on this call, there are a lot of notices that have to be delivered, and it's important that they be delivered in a timely fashion. And then finally, we need to make sure that we know the concept of a prohibitive transaction. And as the name implies, prohibitive, we want to steer clear of transactions that might or indeed put us at risk of violating some rules and regulations. An example might be if I am the business owner and I've got a retirement plan, why don't I just take the money in the retirement plan and buy an office building that we as a company might lease back and work out of? That would be a prohibitive transaction because I am a party in interest and I'm wearing multiple hats and I've got multiple allegiances. That's just one example. There are others out there, but being familiar with that concept of prohibitive transaction is important. You probably won't ever have to deal with it, but it's good to know what the rules are.
Great, thanks. Thank you, Sandy. And it's, again, always good to have resources, yourself, ourselves, or again, some other folks that you may be working with to get an update on what some of those may be from time to time. Moving next, here's a best practice tip that I really like. We're going to talk about 2 of these today. The first one is creating a fiduciary binder. And we are going to be putting together an ebook, by the way, with some of these best practices and tips. We're going to share a few examples, some document examples, prototypes, and that'll be coming out shortly. I'll remind everybody at the end of the call, but if you want to get a copy of some of these best practices and some of the examples we're going to share with you, we'll be having them in that ebook. I'll remind you at the end, you can send me an email or a call and we'll get those out to you. But creating a fiduciary binder is one of the very important ones. First, the document in there should be the investment committee, the bylaws. And again, this is really where you're putting together that list of best practices and agenda and roles and responsibilities of the folks that are on the committee. Next is a board resolution. And a board resolution, again, it's a big term, but it really offers a formal way for boards to document in writing a decision that the board of directors has made. Board resolutions, they serve as a formal and kind of a legal record in making important decisions. And what I like about it is when you have a board resolution, it serves as proof of compliance when it comes to things like audit and litigation. We're going to show you an example of some fiduciary acknowledgement letters that we think are a good idea. I'm going to touch on an investment policy statement in a few slides. Again, in meeting agendas and minutes, these are very important to keep in your binders. And then the investment due diligence. These are the reports. We'll share an example of one a little later on in the presentation, but this is just showing that, hey, we did our due diligence. We can, here's our performance. This is where it compares to our peers and to the goals of our plan. Sandy, anything you want to add here?
Well, you and I talk about these kinds of things on a regular basis, and we talk about document. And what we're trying to provide you with today is a framework so that you can organize your committee if it's not already organized. If it is, maybe you can refine it based on some of the things we'll share today. And as a result of your committee, formalize it, make sure the parties that are involved acknowledge their duties in writing, and follow the investment policy statement. Document your meetings, decisions you make, and make sure you've got a regular process to review the investment. So whether it's digital or hard copy, keep your files in good order. Great
comment. Next slide. What should be included in your investment committee bylaws? And I get this question a lot. Who should be on a committee? I'm a small company. It's just me. I'm the owner, and I've only got a few employees. Well, you could be a committee of one, right? The key here is, we mentioned, is that you have a process in place, right? And you've got some objectives, and you've got these things in writing, and you're documenting.
Dennis, one thing that I would add there too, though, is that, as the organization gets bigger, you might grow that committee. If you've got multiple divisions, you might have a representative from each division. If you have different geographic locations, you might have a member from each of those locations, so that the committee really is a microcosm of your organization as a whole. Typically, you also have the CFO, human resource representation on the committee as well.
Great comment. I like to recommend to folks too, Sandy, if you have a key employee, sometimes it's great to have a key person within your organization that, maybe is a great part of your field force, so to speak, that can also give some good feedback to the committee in terms of some of the things that they're hearing in terms of the participants. We also like to recommend, if you've got somebody in mind that you can bring in from the outside, right, that maybe serves on another fiduciary committee or has had some experience in the past, to lend some of that intellectual capital and experience to your committee as well. Here again, we see a bunch of bullets in terms of some things that should be a part of that committee bylaw. Purpose and function, we talked about the definition and duties, disclosure of conflict of interest. And, this could be an example would be, let's say my brother-in-law is also my investment advisor and investment advisor on our plan. Again, there's nothing wrong with that. That's perfectly fine. It just should be disclosed, right, to the committee and part of that, so everybody knows. Establishment of officers, attendance requirements is a good one. Having a potential voting process. This is where we usually recommend that you have an odd number of committee members, because this way we can break all the ties, right? There's always that one person that can help break the ties. And then having a process for adding and removing and resigning committee members. As we talked about, as a fiduciary, we've got not only responsibility, but we also have some liability. And so we want to make sure that we have a process in place to do that. As Sandy mentioned, documenting is very, very important. The next few slides are going to be some examples. Here's a sample of a board resolution that we talked about. And again, we've got some good language in here. This will be part of our ebook. But I want to share with you on the next slide is, and I think this is an important sentence, is to indemnify and save harmless. by providing a board resolution, it really provides that foregoing indemnification. Again, it's not a provision that's intended to solely relieve any such person of any liability, but it also helps in terms of if we need to limit or eliminate some liability, particularly if somebody is relinquishing their fiduciary responsibility. Anything you want to add here, Sandy?
No, but yeah, a lot of times this is not, a lot of times folks don't think about doing this. And so the indemnification is a great way to help those individuals willing to participate on the committee and protect them from, excessive liability. That doesn't mean that it eliminates their ERISA, their responsibility under ERISA, but it does limit it and provide some protection as far as damages and costs and expenses of attorneys that can be carried by the plan sponsor.
Great. Here's an example of a fiduciary acknowledgement letter. This is again a great form to outline, particularly to by who we are appointing as a fiduciary for the committee, and a couple of neat bullets here. It does not require any extensive experience in securities or analysts. Sometimes people think they've got to be an investment expert or they've got to come from that side of the house, so to speak, to participate in one of these things, and doesn't mean that at all. And it really is to help develop that conscious formation of and community between setting goals and objectives and working with the fellow committee members. Here's another example. This is a responser and acceptance letter. So not only are we acknowledging that we want you to join our committee, but here's in writing the committee member accepting the appointment to be part of that committee. And then if they decide to leave the committee, here's an example of a resignation letter. We always suggest that as committee members change, that if they leave the committee, that they also again put in writing that they are no longer going to be part of it. And then us responding to that resignation letter that we indeed understand that you are leaving, and we recognize that. So what is the investment policy statement, and why is it important? An investment policy statement is a document that outlines overall objectives of the plan and guides future adjustments and changes to the investment. This is a document that really provides all those general goals of the plan and its objectives and who's responsible for what. Very, very important document. Some examples, this could be, some goals that you might have for the plan, as Sandy mentioned earlier, in terms of a performance. We want our plan to perform as well as other plans of its type and make in terms of the markets or particular indexes. We want our plan to perform in terms of fees, that our fees are in line, might be a goal of the plan with the other competitive offerings that are out there. As we mentioned, cheaper isn't always better, but are we getting what we're paying for? And sometimes as we make changes in our plans, are we paying for something that we just don't need anymore as well? It could be goals like a participation. And again, we talked about outlining how often we're going to provide education to be compliant with 404C and how we're going to do that. Maybe are we going to do lunch and learns? Are we going to invite outside folks in to provide this information? Are we going to give newsletters? So this is really the statement. This is the place where we're going to really get detailed in terms of what the overall goals and objectives are and how we're going to implement them in terms of the plan. Sandy, would like to add something here?
Yeah, we're seeing a good bit of interest in socially responsible investing, and that would be another example of something in the investment policy statement. Whether you want that, you don't, you'd want to document it. If you want to use index funds versus active funds, if you want a particular level of performance compared to their peer group. In other words, if you want all your funds to be in the top 25% of their peer group, you would document that in the investment policy statement. And it's a living, breathing document. Things change, and you want to periodically pick up your IPS, review it, and make sure that it continues to meet your objectives.
Great. One of the things too that I like to recommend is is to have a process for change. You know, if you're going to make changes in your plan, what's your process for making those changes? And those are good, again, good items to discuss during your committee meetings. We have a poll question here. Who typically signs the investment policy statement? And we sent our survey out, and our survey said all of the above. So the plan sponsor, the trustee, and the investment manager all sign the investment policy statement. Next, we'll talk a little bit about meeting and agendas. And here's an example of a best practices for having an agenda and meeting. We talked about the governance and general governance orders, calling the meeting to order. One of the things here is we're recommending to folks, particularly this time of year, is some of you may or may not know, we are in what's called a restatement period under the IRS. It started in June of 2020. It ends in June of 2022. And all 401k plans need to be what's called restated during this period of time. It comes around about every 6 to 7 years. And so during this time, this is definitely a great time to take a look at your plan, make sure that all its articles and everything are what you want them to be. This is a good time to look at your vesting schedules, your eligibility, you know, how the plan's govern in terms of a safe harbor, non-safe harbor, all that good stuff. And so these are the types of things that we like to recommend and folks should be looking at during the committees. This is also where to take a look at those things we talked about, like plan performance, you know, any issues, maybe contributions and deferrals or some problems that we may have had along the way, employee engagement and other controls and best practices. Sandy, anything you want to add here?
No, I think you covered it.
Great. You know, here's an example of a investment due diligence. And so we run these reports, we give them out to our plan sponsors on a quarterly basis. And this is one of many types of reports that exist out there that kind of gives a broad picture of where our investments are performing compared to its peers in terms of rate of return and the amount of risk that we're getting to achieve that. You know, here's an example that a fund that may be getting outside, and this doesn't necessarily mean, you know, in our committee meeting, we're going to say, hey, let's fire that fund manager. But we're going to talk about, you know, maybe we're going to put that fund manager on a double secret probation. You know, why is that fund performing outside the line, and what actions will we take or do we need to take in the future? What can I do to protect myself from lawsuits and IRS trouble? Here are some tips to keep you in good graces with the IRS and reduce your risk from potential participant lawsuits. You know, and one is oversee of annual compliance. You know, we talked about, and you'll see a few examples in a few minutes, you know, compliance, and we live in a very litigious society, and we're seeing a lot in terms of audit, and we're seeing a big change in terms of fines. You know, you'll see in a few slides that just, you know, something like not filing our 5500 on time or not getting notices out, what that could mean in terms of a liability and also in terms of fees and fines. Monitoring plan fees. This is one of the things that the auditor takes a look at. They just want to make sure that you're doing something versus nothing. We recommend to our plan sponsors that they maintain and have fidelity bond coverage. You know, generally, each plan must be bonded for at least 10% of the funds they handle as of the first day of the plan year, subject to a $1,000 minimum. However, 401k plans are not obligated to have more than $500,000 in total coverage. And so there are a couple exceptions to that rule. If the plan holds employer stock, 500,000 cap is increased to $1 million. And for plans that hold non-qualifying assets, real estate, or limited partnerships, the minimum bond amount is the greater of 1, 10% of plan assets, or 2, 100% of the value of the non-qualifying assets. 401k plan can purchase more coverage, but it's not required. And furthermore, an ERISA fidelity bond cannot have a deductible. I get that question a lot. In other words, it must cover the first dollar of loss. Your current advisor and or a plan provider can point you in the right direction. Obviously, you can approach one of us. And but a lot of folks will get their fidelity bond coverage from their property casualty agent. A lot of times they can bundle their fidelity bond coverage in with some of their other coverages for the business, like their commercial liability and those types of things. Sandy, quick question for you. You could share with the group, when you see fidelity bond coverage out there in the marketplace, typically what does something like this cost? We get that question a lot.
Yeah, it's a couple $100, give or take. It's not at all expensive. And, it's easy to forget to review that. And as we all know, fortunately, retirement plans generally go up. And so that 10% from last year's number could easily, be too low. And the Department of Labor really can get upset with us if we don't do a good job of keeping the appropriate amount. And again, it's cheap and easy to get. So there's no reason why we wouldn't want to do that.
Great, thank you. Another best practice here is maintaining digital records. It's critical to maintain clean records during open enrollment. If your plan is audited, the IRS wants to see proof that eligible participants were given the opportunity to participate in the plan. And if the participant declines to participate, maintain a scanned copy of the enrollment form. And this one we see a lot, right? We'll see a lot of times where, it's no problem making sure that we invite everybody to the plan and get those notices out. But sometimes we see in the lack of record keeping, if a participant declines, and then making sure that they sign off that they have declined. If your plan is online enrollment, we recommend that you run a report that itemizes the participants who enroll in the plan and those that decline to contribute during the open enrollment period. For a lot of our plan providers, a number of the folks out there that we work with, your plan providers today, can keep some of this information or provide those reports as well. Another best practice tips here is administration documents. So we talked about the two binders. This is your fiduciary binder, right? And in this binder, this is where you would keep all those hard documents. And we see these, in a good place to keep these, of course, is electronically as well. But that adoption agreement, your basic plan summary document, your ERISA bond. I like and always recommend folks have a fiduciary calendar with annual deadlines. Deadlines for when we got to get that 5,500 out. When do we have to mail those notices out? Those types of things. Annual valuation, your annual compliance reports, of course, your form 5,500, and your annual reports. The form 8955 or SSA, that's an annual registration statement. It identifies identifying separated participants with deferred vesting benefits. Those are important. And with those statements, we always want to make sure that we're doing our best to try and keep good addresses and records of those folks that maybe have left that still have money in the plan. Dan, you would like to add anything there?
I think you've got it. The one thing is right now, as an example regarding the fiduciary calendar and deadlines, is if your plan is not safe harbor, then you've got until March 15th to make sure your ADP test is done. If you've got excess contributions, you've got until March 15th to get those out of the plan. So, working with your various providers to develop that calendar, will help make sure you're hitting all the marks. Great.
We've got another poll question here. When is the form 5,500 due for a 12/31 year-end plan without extension? And the survey said July 31st. So the Secure Act update, again, as I mentioned earlier, we live in a very litigious society, and we're seeing a lot more in terms of compliance and audits, particularly from the IRS and the regulators with 401k plans. I'm going to share a couple of examples of those in a few minutes as we close. But the Secure Act is a new act that we know came about and was passed in December of 2019. It also introduced several changes in the retirement space, including some new penalties. Here you'll see the IRS penalty for a late form 5,500 is $250 per day with a maximum of $150,000 per year. IRS penalty for that late for SSA form, which I just described, is $10 per participant per day with a maximum of $50,000. And the Department of Labor can assess a penalty of $2,330 per day with no maximum for a late form 5,500 filing. And so again, Really, really important. And by having a good committee or a process, you won't have to worry about missing any of these things. So let's talk about here in our closing minutes, what are the types of 401k investment fiduciaries? We talked about the administrative side. We've talked a bit here on the investment side, but let's talk about that fiduciary responsibility when it comes to the investment piece and the providers. And the question I always like to ask our plan sponsors is, are you working with an investment fiduciary? And what we mean by that is there's basically two different types of advisors in the marketplace. You have what's called a 321 investment advisor and a 338 investment manager. And the 321 investment advisor typically it's a broker, right? It's somebody who's properly licensed in the business. They're a broker. They may be getting paid a commission. They may work for a particular company or organization, plan provider. And you'll see in the definition, they can advise and help you make decisions, but they're not, or they have the authority to work in a capacity to actually make those changes on your behalf. They also don't have the level of typically at times standards and education in terms of managing assets on a daily or a weekly or a monthly basis. With a 338 investment manager, we'll get into the definitions here. 321 may be a good solution if, again, you would like to have a partner to help you, want to manage your plan assets. You can act as a co-fiduciary. The investment advisor's role is limited, as I mentioned, to recommendations, but you'll still be responsible for the selection, monitoring, and updating of the plan investment choices. With the 338 investment manager, this may be a good solution for you if you want to give up some of that control, as we talked about, and delegate to that investment manager. That 338 will ultimately have that full discretion. A 338 investment manager has both the credentials and expertise to step in and manage the plan assets. And investment managers typically charge fees for their services. They're not paid commissions or in exchange for anything in terms of a product or services. Dan, you'd like to add anything here?
Yeah, just to drive home the point that you opened up with, and that is, just like it's good practice to have members of your committee document their acknowledgement of their fiduciary role in writing, you want to do that with the investment advisors that you're working with. Some advisors won't do that. You can choose to work with them or not, but it's a good idea to ask your advisors to put their fiduciary responsibility in writing, just so that everybody's on the same page.
Great comment. We're going to close. So we're going to open this up. We're approaching the 40-minute mark here, and so we're going to open it up for some Q&A here in a couple of minutes here. Just wanted to give you a couple of examples, as we talked about, that are going on out there in the marketplace today. This is an example. Fidelity got ordered to pay $28.5 million to settle a 401k lawsuit. And in this particular lawsuit, this one was interesting. This lawsuit was actually brought by the employees of Fidelity against Fidelity. And the reason for this lawsuit was that they were giving more favor, so to speak, to current employees versus former employees. They also failed to monitor, the court found, their proprietary funds and their expenses. And also they failed to monitor the occurring and reoccurring expenses. So, of course, in the Fidelity plan, they had Fidelity funds, and along with it, they had Fidelity administration, and those charges just kept going up and up and up. And there was really not a lot of oversight in terms of those being handled by the company. And so they were sued in that example. Another one here, a place that I love to shop, Trader Joe's. And in this particular example, what we saw here was they had a 321. They had a broker who was on this plan. And what was happening here was that the share classes were not deemed appropriate for the size of the plan. As you can imagine, Trader Joe's is a pretty big plan. And so the brokers on this plan were getting paid commissions as the plan continued to go up. Their commissions continued to go up. And the share class that they were selling paid them more money than if they would have chose a different share class. And so the court deemed that it was not in the best interest of the participants in that plan and awarded accordingly. And then the last one was JP Morgan is another example I have here today in the JP Morgan lawsuit. Same scenario as a Fidelity, and that is that they had their funds and or affiliated companies' funds that were in their plan for their employees, and those funds were more highly expensive instead of offering some or including some cheaper options other than just their own funds or their affiliated companies' funds. And so they were fined again by the regulators. So again, folks are out there looking at this stuff on both the IRS and on the regulator side, and so we want to make sure that we're all doing our best to be the best we can be in terms of a fiduciary. Here's our disclosure. Yes.
We've got a couple of questions coming in. I'll jump on two. One question is, what's my responsibility after I hire a vendor? And I presume in that example, we can talk about a third-party record keeper, a third-party plan administrator, a record keeper, an advisor. Those are the typical parties that we see involved. And first and foremost, the exercise of hiring a vendor is a fiduciary act. So you want to, again, be very deliberate about that process. You want to identify candidates, you want to review them, and you want to document the reasons why you made certain decisions. Once you've hired them, you then need to monitor them. And it doesn't mean that you're responsible for the outcome of the decisions that they make, particularly if they have discretion, such as a 338 investment advisor. But you want to periodically review the service arrangements. You want to look at fees. You want to look at the services that they're providing to make sure that you continue to need them. And that too is a fiduciary responsibility that you continue to monitor them. Dennis, anything to add to that before I move on to the next question we've got?
And again, I think it's an important question to ask, when hiring a plan provider or third-party administrator, make sure exactly, what their roles and responsibilities are going to be, and how's that going to line up in terms of your responsibilities as a plan sponsor and a fiduciary on the plan. Great question, comment. You got another question in the queue, Sandy?
Yeah, the next question is about target date funds and what kind of requirements are there for selecting target date funds. And that's a great question because it's target dates oftentimes are just put in the plan because they come along with a particular fund family, or the advisor, suggests fund family A versus fund family B. But what we've found over the last few years is the Department of Labor is looking at the selection of those target dates, just like they're looking for the due diligence on the selection of individual funds. And in particular, there are two types of philosophies for target date funds. As we all may know, the target date fund has a glide path where when we're younger and we're in a target date fund, there's a higher degree of equity. But as we get closer to retirement, the value of that equity is reduced and reinvested in safer investments such as cash and fixed income. That's the glide path. Some glide paths are to retirement and some are through retirement. A to retirement is going to have a much more conservative allocation to stocks once you get, quote, to retirement. A through retirement has a greater degree of equity or stocks later in the retirement years. And it's not that one's right or the other, but you as a plan sponsor, if you have target date funds, need to ask yourself as a committee, do we want to or through? Do we want a more conservative or do we want a little bit more growth-oriented target date funds? And then drive your selection of fund families based on that criteria, and most importantly, document your process.
Great. Thank you, Sandy, for the explanation. I think we have one more question in the queue.
There was a question, can we get the slides? And yes, we'll make sure that the slides are available. Dennis, do you want to comment on how folks can get access to your slide deck?
Yes, so thank you for reminding me of that. In closing today, if you'd like a copy of the slides, just simply send me an email. You see my email here below at dtender@dp-grow.com, or leave me a voicemail message. I'll make sure that you get a copy of the deck. Also, as I mentioned, we are putting together, we've been working on, it's in our compliance officer's hands for review, but we are going to be releasing an ebook. And so this ebook is going to have a bunch of the best practices that we talked about today. It's going to have some example documents that you can use and just plug and play for your own committees and documentation, et cetera. That should be available hopefully within a few days. And if you'd like a copy of that ebook, please, again, just send me an email or drop me a call. And finally, that ebook will also be posted on our website when it's completed as well. You can go to the website. This video webinar today will also be on the Dominion Payroll and DP Grow website shortly. And so you'll have a chance to go back and visit that as well. You know,
hey, Dennis, we actually have a couple of more questions that came in, and in the interest of answering it, we'll go ahead and comment on these as well. So how would you recommend a layperson learn about how to judge their plan investments as best for the participants? Great question. Wow, there's a lot to that. Again, the investment policy statement would be a good place to start. And we can, if there's an interest from this person, email Dennis and we'll give you a little bit more direction. It's probably beyond the scope of a quick answer. There are certainly a lot of great places you can look and research. We'll follow up with an email to you on that. The question also was extended and said, or should we leave the investments to advisor 338? Which I must confess I do. And you know, I think that's a great approach. If you're not confident in something as a fiduciary, you have a role and responsibility to hire somebody to act on your behalf. So, you know, on one hand, if you have that responsibility, learn about it. That was the first part of the question. The second part of it is, if you're not confident in making those decisions, certainly make the effort to hire a third party who can help you. And then the last question is, we have a small family business of about 40 employees. I'm the administrator of the plan. I have a TPA, but I need to get someone to help us advise on the funds. Is that a good idea? It is. Just like your TPA is helping you with your plan administration, the investment advisor can help you understand your plan, the goals, the demographic of your employees, the level of education, investment education they might have, and then point you to the different types of investments and help you build that process of monitoring around the performance of the funds and documenting it accordingly. Dennis, I didn't mean to jump in there, but they popped in right as we were wrapping up, so I thought we'd give it a try to answer.
Great. Yes, no, thank you very much. And again, if you have any additional questions, please feel free to email me at my email address below, dtender@dp-grow.com, and we'll get those questions answered for you, or give me a call or send me a text here. My mobile number's here available as well. I thank everybody for attending today. You know, some closing words is, you know, and really the three things we always talk about is, the key is, you know, have a process, right? Have a process, something versus nothing. I talked to too many plan sponsors over the years that when I start asking a lot of these questions, they just don't even have a process. And so a process is key, I think, to being a good fiduciary and a fiduciary for your plans. Secondly, as Sandy mentioned, document, right? in this litigious society today, I don't think we can document enough. And hopefully some of these best practices and some of the tools we can provide in our ebook will help you to be able to do that. And then lastly is, have some good best practices, and the forming committee, I think, is a good way to do that. It helps keep those things at a forefront. And at the end of the day, helps us do what we all want to do, and that's provide the best thing we can for our most valuable asset, and that's our employees. So I thank everybody today, and I look forward to our next webinar in early March. Thank you, everyone, again, and have a great day.
Thanks, Dennis.